Hello, savvy investors. It's Iggy from Investing Iguana, and today we're diving into a hot topic in the investment world, Mapletree Logistics Trust, which has just received a $1.98 buy rating from UOB Hian. But what's behind this rating, and why should it matter to you? In this video, I'm going to break down MLT's recent 3Q FY24 performance, dissect its strategies, and reveal the factors that make it a potential jewel in your investment portfolio. We're talking about real numbers, market trends, and strategic insights that could reshape your view on MLT. So, if you're looking to make informed investment decisions in the Singapore market, you're in the right place. Let's unravel the mystery behind this buy rating and see if MLT really deserves a spot in your investment radar. Stay tuned. 3Q FY24 Performance Overview. The performance of MLT in the third quarter of the fiscal year 2024 can be likened to an exhilarating roller coaster ride, filled with ups and downs. Despite facing some challenges, particularly from the market in China, MLT has demonstrated resilience and adaptability. They have achieved a noteworthy growth in rental reversion of 3.8%. This growth has been spearheaded by robust performances in Singapore, Australia, and South Korea. However, it's important to note that the journey was not entirely smooth. The occupancy rate experienced a minor decline, indicating a slight reduction in the utilization of their properties. Furthermore, there is a sense of caution regarding the outlook for China in the upcoming year. This is likely due to various market factors and economic conditions that could impact the performance in this region. Despite these challenges, there is a silver lining. MLT has projected an enticing distribution yield of 5.3% for the fiscal year 2025. This is a key indicator of the potential return on investment for shareholders and is certainly a figure to keep a close watch on. It suggests that despite the hurdles, MLT is poised for growth and could offer attractive returns in the future. This blend of challenges and opportunities truly encapsulates the roller coaster ride that is MLT's recent performance. It will be interesting to see how the situation unfolds in the coming months. Financial highlights. Let's delve deeper into the financial highlights of MLT. In the third quarter of the fiscal year 2024, MLT reported a distribution per unit, DPU, of 2.253 Singapore cents. This figure exceeded expectations, indicating a strong performance by the company during this period. A significant contributor to this outperformance was the divestment gains amounting to 12.4 million Singapore dollars. Divestment gains refer to the profits made from the sale of assets, which in this case added a substantial boost to MLT's financial performance. However, the strength of the Singapore dollar presented a bit of a challenge. While a strong domestic currency can be beneficial in many ways, it also had an impact on the gross revenue and net property income (NPI) growth rates. Gross revenue refers to the total revenue generated by the company, while NPI is the income generated from the properties after deducting property-related expenses. The strong Singapore dollar affected these figures, likely due to the impact of currency exchange rates on international transactions. Interestingly, if we were to consider these figures on a constant currency basis, they would have been even more impressive. A constant currency analysis removes the effects of exchange rate fluctuations, providing a clearer picture of a company's financial performance. This suggests that, despite the impact of the strong Singapore dollar, MLT's underlying performance remains robust. It's a testament to the company's resilience and strategic financial management. These financial highlights provide valuable insights into MLT's performance and future potential. Portfolio occupancy and reversions. Occupancy rates are a crucial indicator of a trust's health, reflecting the extent to which its properties are being utilized. In the case of MLT, there has been a slight decrease in occupancy rates in Singapore and Hong Kong. This could be due to a variety of factors such as market conditions, tenant turnover, or property-specific issues. Despite this, MLT has managed to maintain full occupancy in Australia, India, and Vietnam. This is a positive sign, suggesting that the properties in these regions are fully leased out and generating income. Rental reversion figures are another important aspect to consider. These figures represent the change in rental rates when leases are renewed. For MLT, the rental reversion figures have been influenced by performances in different regions. Singapore and Australia have had positive rental reversions, which have helped to offset the negative impact from China. This means that despite the challenging conditions in China, the strong performance in Singapore and Australia has helped to stabilize the overall rental income. In essence, while there are areas of concern such as the slight dip in occupancy rates in Singapore and Hong Kong and the negative rental reversion in China, there are also areas of strength such as the full occupancy in Australia, India, and Vietnam, and positive rental reversions in Singapore and Australia. This mix of challenges and opportunities is part of the dynamic nature of managing a diverse property portfolio like that of MLT. It will be interesting to see how MLT navigates these conditions moving forward. The China factor. The situation in China is indeed a bit complex and has significant implications for MLT. The real estate and stock market downturns in the country have led to a shakeup in consumer confidence. This is a critical factor as consumer confidence often serves as a barometer for the overall health of the economy. When consumer confidence is low, it indicates that people are less willing to spend money, which can lead to a slowdown in economic activity. For MLT, this shaking consumer confidence could potentially affect both demand and rental rates. Demand refers to the desire of consumers to purchase or lease properties. If consumer confidence is low, people may be less likely to make significant financial commitments such as leasing properties, which could lead to a decrease in demand. Similarly, rental rates, which are the prices charged for leasing properties, could also be affected. In a market where consumer confidence is low, property owners may be forced to lower rental rates to attract tenants. However, despite these challenging market conditions in China, MLT has shown remarkable resilience. They have managed to maintain a stable occupancy rate in the country. This means that a significant proportion of their properties in China continue to be leased out, generating steady income for the trust. This resilience in the face of adversity is a testament to MLT's strategic management and its ability to navigate complex market conditions. Strategic moves and financial management. MLT is making intelligent decisions with their capital, demonstrating a strategic approach to financial management. They are actively engaging in a process of divestment and reinvestment, which is a key aspect of their financial strategy. Divestment involves selling off properties, particularly those with older specifications and limited potential for redevelopment. This allows MLT to free up capital that can be better utilized elsewhere. In the first 9 months of the fiscal year 2024, MLT has executed 8 such divestments, amounting to a total of 207 million Singapore dollars. These divestments were spread across different regions, 2 in Singapore, 5 in Malaysia, and 1 in Japan. Interestingly, these properties were sold at an average premium of 13% above their valuation. This means that MLT was able to sell these properties for more than their estimated worth, further adding to their capital. The proceeds from these divestments are then reinvested, likely into properties or ventures that align better with MLT's strategic goals and have higher potential for growth and returns. This cycle of divestment and reinvestment allows MLT to continuously adapt and optimize their portfolio based on changing market conditions and strategic objectives. At the same time, MLT is also keeping their debt costs under control. Debt costs refer to the expenses associated with borrowing money, such as interest payments. By managing their capital effectively and keeping their debt costs in check, MLT is ensuring their financial stability. This is particularly crucial in the current economic climate, where there is anticipation of rising borrowing costs. Market outlook and stock impact. MLT is strategically repositioning its focus towards modern logistics properties that are located near population centers. This shift is part of a broader strategy to rejuvenate its portfolio, moving away from older, less efficient properties and towards modern, high-specification logistics properties. These modern properties are designed to meet the demands of today's logistics operations, offering features such as larger storage capacities, advanced security systems, and more efficient layouts. The management of MLT has identified several growth markets for expansion, including Malaysia, Vietnam, and India. These markets are experiencing rapid economic growth and increasing demand for modern logistics facilities, making them attractive investment destinations. In addition to these growth markets, MLT also sees potential in Hong Kong and Japan. Despite the tight supply of properties, especially in prime locations, these markets remain attractive due to their strong economic fundamentals and high demand for logistics services. On the other hand, Australia and South Korea have experienced what is known as cap rate expansion. The capitalization rate, or cap rate, is a measure of the potential return on an investment in real estate. An expansion of the cap rate suggests that the potential return on investment has increased. However, the capital values in these markets remain high, indicating that properties are still expensive despite the higher potential returns. In line with its expansion strategy, MLT has recently deepened its presence in India with the proposed acquisition of a modern Grade A warehouse in Farrukhnagar, Delhi. The purchase price for this property is 900 million rupees, 14.5 million Singapore dollars. This property is fully leased to one of the largest third-party logistics players in India for a period of 8 years, providing a steady stream of rental income for MLT. Final analysis and recommendation. So, what's the final analysis and recommendation? MLT has been given a buy rating by UOB Hian, a renowned financial firm, with a target price of 1 Singapore dollar and 98 cents. This suggests that the firm believes MLT's stock is undervalued at its current price and has the potential to increase, making it a good investment opportunity. Despite facing some challenges, MLT appears to be well-positioned for growth. This is largely due to their strategic decisions, which include a focus on modern logistics properties and expansion into growth markets. These decisions demonstrate a forward-thinking approach and an ability to adapt to changing market conditions. In addition to their strategic decisions, MLT's financial prudence is also commendable. They have managed their capital effectively, engaging in strategic divestment and reinvestment, and keeping their debt costs under control. This prudent financial management is crucial for maintaining financial stability and ensuring sustainable growth. Furthermore, MLT's market diversification strategy adds another layer of resilience. By having a presence in various markets, they are able to spread their risk and take advantage of different growth opportunities. This diversification paints a picture of a trust that is not only resilient in the face of challenges, but also has significant growth potential. For the discerning investor in Singapore, MLT is definitely a trust to watch closely. Its strategic positioning, financial management, and market diversification make it an attractive investment opportunity. However, as with any investment, it's important to conduct thorough research and consider your own financial situation and risk tolerance before making a decision. But based on the current analysis, MLT certainly seems to be a promising prospect. And there you have it, folks. We've dissected Mapletree Logistics Trust's 3Q FY24 performance and explored the reasons behind UOB Hian's $1.98 buy rating. Now, it's over to you. What do you think about MLT's potential in your portfolio? Are you convinced by the numbers and strategies we've discussed, or do you see things differently? I'd love to hear your thoughts, so drop a comment below and let's get the conversation rolling. If you found this analysis helpful, please hit that like button and share this video with your fellow investors. Your support is what keeps Investing Iguana thriving. Don't forget to subscribe and turn on notifications to stay updated with the latest investment insights and trends. Until next time, keep investing smartly and stay ahead in the game. This is Iggy, signing off. Happy investing, everyone.